Alright, welcome to this section. Under this section, we'll be talking about the finance environment and the role of financial managers. Alright, in order to understand the financial environment, first of all, I would like to define what the corporate finance is all about. When you hear the word corporate finance, is mostly concerned with the efficient and effective management. Efficient and effective management of finances within an organization. Your financial implication or your financial objectives has to be matched with the overall vision of the organization, and it has to be well planned. Alright, so in order to achieve this, there has to be a proper planning and control of provision of resources. When we are talking about planning and control, this includes where funds are raised from. Funds are raised from somewhere, allocation of resources, that is where funds are deployed to, and finally control. So that begins to tell you what the financial manager does. Of course, you know, in most countries, there are no one individual who is solely responsible for corporate financial management, especially in major developed countries like the UK, the financial cities, the New York, Japan, and so on. Alright, the financial department is broken down into several units. We have the treasury, we have the cash management, the treasury with deals or responsible for cash management. We have the core investments analyst, we have the core financial reporters, and so on. Okay. Alright, so basically we're going to talk about the role of a finance manager. This is very crucial. The role of a finance manager. There are three major basic roles. Number one is the investment decision. Number one role is the investment decision. Number two is the financing decision. Number two is the financing decision. And number three is the dividend decision. Let's go back to investment decision. What does this literally mean? Every financial manager is concerned with how to make good investment decision. That is, where do we put our money? Where do we put our resources into? When we make excess of profits, where do we deploy this resource to make further resources for us? Should we put our money in bonds? Should we incur more capital projects? These are crucial decisions that could make or mar the company as a whole. The second one is financing decision. This is concerned with raising funds from wide variety of institutions and markets, with each source of finance having different features. A manager could decide to raise finance from the stock market. Another manager could decide to raise finance from the bank through debenture loans. So that's one crucial decision. Now, each decision will be influenced by the circumstances surrounding it. For example, if you are hoping to raise a loan note or a debenture note, the manager should also factor that interest payments will be paid. Alright, so different circumstances. Number three, dividend decision. At some point in time, the manager will be concerned with how much of funds it will retain at a particular period to be able to pay shareholders. You know ultimately that shareholders are the owner of the company. They're the true owners of the company. And as good stewards, managers should be able to pay them at the end of a particular period, all right, in the form of dividend. That is the way they can recoup back their initial funds that has been invested. All right. Okay. So let's talk about corporate objectives or the corporate social responsibility as it concerns with the objective of maximizing profit or maximizing shareholders' wealth. Okay, so under this section, we're going to be dealing with corporate objectives or corporate social responsibility. It's the same thing, and the relationship with maximizing shareholders' wealth. Shareholders' wealth. All right. Corporate social responsibility. I'm sure you have heard about this word several times. Of course, you know that every institution or every organization is not only accountable to shareholders, although shareholders are part of stakeholders. Yeah, they are accountable to stakeholders as a whole. Stakeholders could be classified as internal and external. When you're talking about the internal stakeholders, you'll be talking about the employees, basically. Yeah, but when you're talking about the external stakeholders, you're talking about the shareholders, the public at large. So when we're talking about corporate social responsibility, how do we become accountable to the public? How do we become accountable to the external stakeholders? How do we show ourselves as being responsible to the needs of the society? Let me put it in another way. How do we show that this company or this institution or this organization has contributed to the needs of the economic environment? For example, let's say a company AYBC Limited has just recently supported 5,000 students by paying their scholarship or by paying their school fees for the next 5 years. It's an example of social responsibility. Some organizations even go ahead as far back as building roads, as far as building roads, creating social amenities, helping to improve the standard of health care. It is not their primary objective to do so. That is secondary, but they are taking this as part of their vision, and this is what we refer to as corporate objectives or corporate social environment, corporate social responsibility. You should know that the owners of the company are shareholders, and the primary objective of corporate finance are usually stated by maximizing shareholders' wealth. Please take note of this. The primary objective of corporate finance is to maximize shareholders' wealth. When is shareholders' wealth maximized? When they receive their wealth or when they receive dividend. Very important. And capital gains. When they receive dividend and capital gains, shareholder wealth will be maximized. Please take note of that. When they receive good dividend, and capital gains. What do we mean by capital gains? Capital gains will arise when an asset such as shares is sold and a gain is realized. So when they are able to take their shares to the stock market or the secondary market and sell and make good gain, shareholders' wealth would have been maximized. Please take note of that. All right? Okay, so alternatively, the company or the shareholders' wealth maximization also exists due to the existence of number of interest groups, and that was what I was trying to explain, and stakes in the company who have differing views. What I mean by differing views there is they all have different views on what the company should achieve. However, companies do have to consider other stakeholders which may adopt other several objectives. Now, just like I was saying, these other stakeholders, for example, like the public at large, will want the community to be developed. They will want good social infrastructures. They will expect that the company does that or provides that for them. But you should know that this objective is somehow conflicting with shareholders' maximization. Why did I say that? Like I explained the previous just a while ago, that shareholders will want their wealth to be maximized by increased dividend, one. Number two, increased capital gain. If you want to achieve that, you may be jeopardizing the interest of other stakeholders group, like the public. Because if you spend a lot of resources trying to please the public, the shareholders who are the true owners of the company may not have enough dividend to play with at the end of the year, or to possess at the end of the year. So those two objectives are somehow conflicting. Alright, so other objectives of the company, I'm not going to spend time here. Maximization of profits. They want to maximize profits, and please take note that profit maximization occurs when marginal revenue equals marginal cost. But there are three fundamental problems with profit maximization. Number one, it concerns the time scale over which profit should be maximized. When you're saying that profit ought to be maximized, most often times we don't attach time to that. Alright? Part of this indecision will raise this question: should profit be maximized in the short term or the long term? Now, number two, the second problem is that there are too many quantitative difficulties associated with profits. Let me give you an example of that. Some profits are not cash based. Some profits are not cash based. For example, depreciation is not it's not an actual cash flow. All right? So if I reduce depreciation in a particular period, my profit will shoot up. Or if I introduce a favorable depreciation policy and I expense that in my statement of comprehensive income, my profit will shoot up. So profit itself is not, there are so many difficulties associated with it. Number three, maximization of profit does not take account of risk in terms of inflation that might occur. Taxation issues, taxation issues will be factored in, but major risk like inflation and so on. Alright, so other one includes maximization of sales, pursuing sales to meet the overall company objective. Number three, survival. Survival, cannot be accepted as a satisfactory long-term objective, but the company needs to be able to survive in its long term. Number four, social responsibility. We mentioned a while ago what this means: being accountable towards the needs of other interest groups, especially the employees, the local communities, and the public at large. Alright, so we'll talk about agency theory. We want to talk about agency theory and its relevance to financial managers. Agency theory and its relevance to financial managers. Before we move on, you must appreciate that the problem of agency is said to occur when managers are clearly not acting in the interest of shareholders. But before I move on, let me say that agents are parties that are elected to act on behalf of another party. Let me break that down. If I'm the owner of a company and I appoint directors to run my company for me, those directors are called agents. Why? Because they are acting on my behalf. But there is a problem with this. There is a problem associated with this. And the problem is that managers, in most cases, don't act in the best interests of the company. They don't act in the best interest of the company or the shareholders. And three important characteristics contribute to the existence of agency problem. Number one, there exists a divergence of control and ownership, whereby those who own the company, the shareholders, do not manage it but appoint management to run on their behalf. So the ownership and control has been divided. It is easier for individuals to own and control the company because there will be unity of purpose. But right now there is no unity of purpose. There is divergence. Number two, the goal of the company differ from those of the owners. The goal of the company differ from those of the owners. What do we mean by that? The goal of the company could be survival. The owners of the company may just want to maximize shareholders' wealth. The goal of the company could be expansion or more detailed strategic objectives, which may not be in line with the goal of the owner of the company. So there is always a conflicting goal between the owners of the company and the company itself. Alright, so management, as a consequence of running the company on a day-to-day basis, has access to both management data or financial information, and shareholders only receive annual reports, which is subjected to manipulation. So what that means is that the owners of the company in most cases don't have true information, or they don't have access to all the information of their company, whereas the managers are the ones in possession of all the relevant details. Okay, going somewhere. For this reason, there is always conflicting issues. There are always conflicting issues between the owners of the company and the shareholders. I don't want to jump, but the owners of the company, most especially, they want to maximize their own returns.